This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the TwinPetes Investing podcast. My name is Peter Higgins and you can find me at Conkers3 on Twitter. And I'm here with my good colleague Peter at Wheelie Dealer on Twitter. How are you doing, Pete?
Yeah, I'm okay. Usual, ongoing issues, but I'm okay. So it's cool.
Cool beans. Now, I want to say a big thank you to everybody that's been supporting us with this podcast. Pete and I forgot a while back to thank you all for helping us get over 100,000 listens, downloads, etc. We've surpassed that by a mile now, and I think our next benchmark is going to be 150,000 listens and downloads. We may miss that, so if we don't make the announcement, we'll probably make it at 200,000. But I just want to say thank you ever so much for you guys, ladies and gents, that are all over the world that are listening to us. We had a really great tweet from one of our followers that's listening to us from down in Australia, and we'll talk about that a bit later on. So I just wanted to just give you guys, ladies, gents, a big thank you from us, and just thank you for your continued support.
Absolutely. I mean, thank you so much, people. I mean, it's just been absolutely incredible. And the thing that me and Pete are both so pleased about is that people are listening to the archive. You know, the old stuff is getting used. So that's just fantastic.
Yeah, I think one of the incredible thing for us, and we keep saying this and people keep going, no. But we are just two ordinary guys. Yeah, yes, we've got a passion for investing. Yes, we've got a passion for learning. But the most important thing for us is that we want other people to learn too. We don't spend our time focusing on the stocks that we've got. We don't spend our time trying to ram stocks down people's throats so they can go and buy it and create liquidity for us to get out. You know, we're long-term investors, so we're wanting other people to become long-term investors too. And I think the important thing of all is that we're looking out for each other. And I'll be talking a bit later about the charity that you guys have all, ladies, have supported as well. You guys have been absolutely phenomenal, and that's what keeps us energized to do this podcast. Yes, it's a lot of work, but it's worth it when we know that we're helping other people beyond just the podcast and just beyond investing as well.
Oh, totally. I mean, one of the things that, funnily enough, we were talking about just before we started this call, was we were talking about how if you treat other people well and do good things and whatever, the market gods look after you. And I'm a big believer in that. And you do need a bit of luck in this game. And obviously there's a lot is about, hard work and all the rest of it and learning what you're doing. But you do need a bit of luck. And if you've got the market gods batting for you as well, then that helps, you know what I mean?
Yeah, I think you've had them backing you for a long time, Pete. I think I'm just catching up with you, mate. So, Hey,
I know that I need to appease them and give them the odd sacrifice every now and again.
Yeah, steady on. What are you talking about? Sacrifice, mate.
The odd entrails or something, you know it is.
Oh my gosh. No, so one of the people I wanted to give a shout out to is a lady called Katerina, and you can find her at _MTAUS as in Oz. She put a great tweet out for us, and I'm shouting this one out because it's obviously from Australia. We've got loads of other people that listen to us as well, and we give them shout outs occasionally. She just wrote, "Great podcast, Pete and Peter. Love hearing how both of you research differently. Always give a different perspective." So yes, that was really, really nice.
Oh yeah, thanks for that. Thanks, Katerina. That's awesome.
Yeah, so I'm hoping we'll hear more from Katerina going forward as she gets more familiar with our podcast. Pete, do you want to start with the markets, or do you want to start somewhere else?
Oh yeah, let's just. I mean, it's been quite a surreal market really, because the thing that's really hit me this week and last week, really, is there's just so little news around. I mean, I know that must always happen every summer, and you'd have thought after all the years I've been doing this, I would have sort of got used to it. But it's shocking. It's like some more like today. I wake up and I'm looking through the RNSs, and there's probably only 10 things that I even remotely can tweet about or want to tweet about that are of interest to me. Most of it, it's just really quiet for news, and obviously that links to not much volume around. I mean, volumes are just absolutely on the floor.
Volumes are on the floor, mate. But I think the main news we've had, and I'll go on to the market shortly, is that we've got predators everywhere, mate, trying to buy up UK stocks because they're seeming that they're cheap. And one of the things I'm loving about Twitter and social media and some of the articles I'm reading at the moment is more people talking about the sum of the parts or the intrinsic value of what this stock or this company is worth. Whereas 6 months ago, a year ago, no one was talking about that. And I think the good thing about looking at the sum of the parts regarding stocks or intrinsic value is that enables people to have that margin of safety. We've talked before about stocks having a high PE, but whether it's a high PE or a low PE, it's no longer the go-to metric for stocks anymore, Pete. People want that margin of safety. They want to know, if this stock is worth £1, why am I buying it at a premium of £1.30? I don't want to be buying it at £1.30. I want to be buying it when it's at a discount. So they have that margin of safety. So people are thinking more about not getting caught on spikes, not getting caught on a stock that's gone ahead of itself. So I'm really, really pleased about that. But yeah, M&A, lots of takeovers, private equity coming out like vultures and predators, trying to buy up a lot of our stock. And it's not over with yet, mate. I've been saying it for X amount of months. There's more takeovers coming. And before I came onto this call, another one of my stocks has been or attempted to be seized by somebody. So yeah, it's ongoing, mate.
That's fantastic, isn't it? I mean, you sort of mentioned before the call that it sort of cheered you up for the day. Which one is it then? What's happening?
Well, the stock is called Bacanora. It's a lithium play, Pete.
Yeah, BCN, isn't it?
BCN, yeah. So that's just come out, and basically their 50% partner has decided to buy them out. Essentially, it's something that was started prior to me getting in. It was back in May that it all kicked off, and today they've decided to offer 73 points. I think it's 6 pence per share for that. So yeah, so that's what's going on there. But as I said to you before, I've been buying up a few mining stocks. Lithium is the mainstay of what I've been buying. I've kept a load of those quiet because I'm ordinarily pretty poor when it comes to mining stocks. But the mining stocks have done well for me in the past 12 to 18 months, and one of them that I've held for a bit longer than that, I'll disclose when it becomes a 10-bagger. That's the bet I've got with the guy, and that's been mentoring me and coaching me as to how I can get better at analysing these stocks. So when that 10 bags, I'll disclose it. It sounds a bit rich and it's a bit cocky, but I'm not being cocky. I'm just trying to show that stocks can do well without people ramping them.
Yeah, I mean, is it Bacanora, isn't it? Bacanora. I mean, that's up 19.6% today, 67p. Well, that's still below the 73. And do you think there will be a bit of a tussle for it then? Do you think that's possible?
I'm not sure about the tussle. What happens sometimes when companies make an offer for a company, but it's not all cash? Yeah, and it's part of this. They're getting 0.23589 of Zinwald shares to be distributed to Bacanora. So usually there's a discount. If you say, we're going to offer 75 pence, the shares pop to 72. If they think there's going to be a bid battle like has been happening with Morrisons, then the shares sometimes go above the actual offer that they've got.
Yeah, I've seen that.
So that's what's happening with that particular one.
What is Winwald? What's that?
Essentially, that's what they're going to be using as the vehicle. Yeah.
Okay.
To distribute the shares.
Do you think it'll be something that's tradable, or is it, will it be a listed entity that people will be able to trade, or is it just something?
Well, I sure hope so, Pete. Otherwise, what happens with these things is that when it happens like that, Pete, ends up being a sort of situation where you end up with a distribution which you don't actually want.
Oh, yeah, totally, yeah.
Or it's on a platform that you don't really want to be involved in. So it's all those sort of things to keep an eye on. I'll keep an eye on it and see what happens. For
And
me, this is
obviously what you can do is you can sell it in the market.
sell it in the market.
Bacanora.
Yeah, absolutely.
Do you think other shareholders might put pressure on Winwold or whatever it's called to up the offer?
There's always the hope of that, Pete. There's always the hope of that. I mean, the thing is, they're looking to distribute this particular portion of a share as you know, at the effective date, which they're hoping to be December 2021. They're looking to distribute it. So we'll see. I tend not to spend much time on that particular side of that aspect of it, because for me, it's just, you know, it works out at just shy of 6p per share of that. So we'll see. Hopefully they'll push it up before that sort of time frame.
No, mate, that's interesting. I mean, congratulations. Hey, it's interesting on miners because a lot of them seem to have come off the boil lately. It's like the major miners. I mean, I hold Glencore GLEN myself, and that one, you know, it's been doing all right really, and it hasn't really come off in the big way that a lot of the smaller miners have. A lot of the gold miners come off. A lot of the platinum miners seem to have come off. I noticed, I was looking at APF today, Anglo Pacific, yeah? That's come off a lot. And it just, bad results, by the way, but there just seems to be a general thing that a lot of the excitement that was there earlier in 2021 seems to have gone away on the smaller stuff, really.
Well, it's not just smaller stuff, Pete. I hold Rio Tinto, and that's come off quite a lot as well. And all of it stems from the Chinese push towards curbing steel production and all that sort of stuff. So iron ore has been routed, and all the other listed sort of companies have had a bit of a rout. So I think you're talking about the likes of Sylvania Platinum, AAZ, and other companies which have seen their share price really halve in certain places because of what's happened. A lot of them peaked some months ago, and they've been drifting ever since. You know, and during the summer. So I think that's what's going on there regarding certain and there'll be some bargains to be had. But like I say I have a few calls with people, and people send me DMs. Nobody wants a stock when it's drifting down. You know, when for instance SLP was at, I think it was at £1.40 or something like that. You know, it had been from a low of say 15p. Sylvania Platinum. And if you remember, I think it was I'll Get You Gadget when he was on the show. Ryan was on the show with us. I'm sure that was one of Ryan's stocks. We were talking about palladium and the catalytic converters. If you remember that, that was right, wasn't it?
Yeah, it was. Yeah, I remember that.
Yeah. So that stock in May, Pete, was £1.43. Yeah, and currently sitting at 87p now. Yeah, but a 52 week low is 15p. So it's come down a lot, but it had run up quite a lot on really good metrics and really good news. And I think also, if I remember rightly, it also paid a divvy, didn't it?
I'm not sure about that.
Yeah. So it'd been a stock that'd been on a tear, like a lot of other small cap stocks. Done everybody very, very well. It's drifting now. A lot of people don't want it because they either got into it too late, or they bought it at 15p, 30p, 50p a pound, and now they're watching it go down. It's like, you know what, I can come back to this at another day, or I'm locking in profits.
I noticed the gold price. I mean, we've talked about this before. The gold price has been quite soggy for a while, really. You know, since it hit that sort of $2,000 kind of level, it's been a bit soggy, and I'd imagine that the PGMs, the platinum group metals, have probably had a similar move, and that, you know, when the metals prices are falling, it's always going to hurt the miner, and often to a bigger extent, because it's almost it's like a geared play on the underlying metal.
Yeah, that is true, mate. They're hovering at the moment at $1,800 per ounce, I think, or something like that.
So where's that in relation to where it has been?
Well, like you say, it was at 2000, wasn't it, at one stage?
Oh, gold.
Thereabouts.
Sorry. Yeah, sorry, we're talking about gold. Yeah.
Yeah, about gold.
I was looking at Glen chart as we were speaking then, and with Glen, it's recovered to back where it was 3 years ago, which has made me very happy. And it's sort of now wiggling sideways, doing that classic consolidation move that they tend to do before they then move up again. So hopefully that's what's going to happen with Glen. And Glen is a funny one because it's had a lot of changes with Ivan Glassenberg, the sort of CEO, chairman, whatever he is, moving on. He's dominated that company for so long, and he's now moved on. And, there's going to be a lot of changes happening there. And hopefully it'll become less of a sort of, company with question marks around it, and it can become a sort of bit more professional. But that's rude. I mean, I don't really mean that about them.
Careful, mate.
I don't mean that. It's like, I don't know. I just think, they've had so many problems with corruption things, bribery things, this, that, and the other. And of course, you've got all the environmental issues, and it's never easy for these big miners. But the irony is, the world so needs big miners. They're essential, and so I think it's going to be an interesting time for the miners with all the green stuff and whatever.
Yeah, I'm having a very interesting conversation with somebody just this week, Pete, and it goes back to the fact that once you go from a small cap to a mid cap. Once you go from a market stall, as in some of the companies in Leicester have done that, Dunelm and Next have done that sort of thing, you go to a very difficult place because you've got so many people reporting into you. A CEO probably has 50 to 100 people reporting into him or her. And how well do you know what's going on the ground floor, in the trenches regarding some of these companies? And it only takes one bad apple to ruin the reputation of a whole company. So for the likes of Glencore or anybody else that's a large cap, it's an absolute nightmare to manage that sort of bureaucracy or infrastructure.
Well, it's global as well.
It's global, mate.
Lots global in loads
cultures to deal with.
Yeah.
I mean, absolutely.
In a lot of ways, and it's funny what you said about market trader and then growing bigger. It's like when you're a founder kind of business and you're very small, I'd imagine, I can be pretty sure it takes very different skills to run a business, up to a certain size than it does to run, a business that is growing and growing and growing within the UK, for instance, that then decides to branch out and move into Europe and move into America and stuff. It's different skills that are needed.
Absolutely different skills. I think you make a really good point there. And I think what I've noticed historically, Pete, is that companies that have got founders and family founders tend to manage their business better, because what they tend to do is make sure that the enlarged family circle, core family, are sprinkled all over the business, and they're keeping a really, really close eye on almost everything, despite the business growing from, say, where you are, Pete, in the part of the world, to the rest of the UK, or from my part of the world in Leicestershire to the rest of the UK. They're trying to keep a tab on everything. There's somebody within the family watching everything. It's not an outsourced entity. You know what I mean?
Yeah, that's an interesting point. I wonder, I've never thought about this, never looked into it, but I wonder if, like, a founder-led business within the UK is less likely to do, European expansion and American expansion and stuff, because it's almost like they actually like keeping the fiefdom quite small. Have you ever had any thoughts about that?
I haven't had any thoughts about that in a sense, but I suspect that some of them want to get big and do get big. Obviously, Dunelm from Leicestershire has grown from a market stall. The stock I was speaking about was only today. I was speaking with somebody about it. And one of the family-led stocks that we spoke about on the last podcast, Pete, was the reason why we're having this discussion, was Clarkson. Yeah?
Yeah.
Clarkson is a global behemoth now. And he describes that as the Goldman Sachs of shipping. And I was like, what? Really? Wow. I've never looked into them deeply enough to know that's how big they are. But they're a family-owned business, Pete, and that's how they started.
But
and they're huge now. And they're global. Yeah, of course they're global. The brokeraging for everybody.
Well, funnily enough, and I actually thought about whether I would raise Clarkson's on this call or not. And you brought it up, so it would be silly not to. Anyway, I put out a tweet about Clarkson's results, I don't know, a couple of weeks ago or whatever it was. And I think what I said was, yes, this is a very good company, but because of the rating it was on like a forward PE of 22 or something like that. I said, because of the rating it was on, I'm not sure I would buy it now. Having thought about that and heard from a good friend about it and heard some stuff that I hadn't really considered, I actually think that, you've got a bit of cyclical risk with Clarkson. It does tend to go up and down. If you look over the years, it has had some pretty meaty swings because the shipping industry is of that nature. But I actually suspect that people who are buying it, around now kind of time, over the years, if they're long-term investors, they'll probably do pretty well on it. And it wouldn't surprise me. I mean, obviously, with the family aspect, that makes a takeover not so likely. But at some point, maybe it will be something that gets taken over. But anyway, what I was going to say was one of the things I hadn't appreciated is the importance of data within that business. And one of the things that I found out today was that they've effectively got like a sort of, it struck me as very similar to a software as a service, sort of cloud-based sort of solution, where basically shipping companies could use this Clarkson solution to take more control of their whole shipping operation and the data involved and everything. And that's a division of Clarkson's that's doing that side of things. That's in addition to data that Clarkson have themselves. So there's so many aspects to this company. I can sort of understand the comment about being the Goldman Sachs of shipping.
Yeah, this is it, Pete. I would really need to spend tens of hours on this, and I probably wish I'd done it many moons ago, many years ago. And if I'd found that out a year, 2 years from now, I'd still be holding that stock now. I've left it to the fact that I haven't bought it. I'm not intending to buy it just yet. If there becomes an opportunity where the share price comes back down and gives me a reasonable price to buy in, I'd be happy to buy it. But the risk I've got is that I'll be looking at that stock again in 3 months, 6 months time, and it'll be plus 40. Yeah.
What's it now?
I think the last time I looked, it was at 30 odd. Let me just have a quick look. I'm conscious that we spoke about this only last week, Pete, and we're back talking about it again. So apologies to our listeners. It's sitting at 36 at the minute. It's got a low of just sub 20, 52-week low. So yeah, I'm ruining the fact I didn't look at it when it was sub 20. It's got a high of 37. It's just below 36 as we just around 36.30 as we speak. If it was to come back down towards 25 and below sub 25, I'd buy it. But that's not me tipping or recommending it to anybody. I'm just sorry I missed out and wasn't even looking at it. It wasn't even on my radar, Pete, when it was down at the lows.
Well, that's how it goes.
That's the nature of the beast. You and I can't buy every single stock that we hear about, mate, and neither should anybody else. Otherwise, it defeats the object. We're back up at 50 odd stocks each, aren't we?
I think it's an interesting point, actually. I think that actually highlights. It was certainly something that I used to do too much, and I've really, hopefully, broken myself of a very bad habit. That, you'd spend time looking at all these different stocks, and not only, as you said, you'd end up with 55, 60 stocks or whatever. I also used to make a mistake of basically just trading too often. Yeah. It's like I look back now, and it just makes me cry. I mean, I think one I looked at the other day was Greg's. What is Greg's now? I don't know, something bonkers like 35 quid or something. And GRG Greg's. Yeah, that's 3022 pence, so it's like over 30 quid. I'm sure I was selling that at about, 8 quid and making a profit and thinking I was bloody brilliant, And it's like, no, I'm an absolute complete idiot, basically.
Well, you're not an idiot, Pete. You know, I'm sure other people will disagree with me saying you're not an idiot, but you're not. But
Yeah, it's a commonly held view.
but the fact is this, Pete. We've all got metrics that we're looking to apply to the stock, right? And we all apply the metrics differently. If you give the same metrics to a bull, you'll see the potential for the share price to be X. If you give the same metrics to a bear, it'll tell you why it's going to go down to A or B regarding the share price. Yeah. So you've bought it, you've made a nice profit on it, you've seen some noise coming down the pipe, or you've seen some things that you're not liking, or the PE's gotten a bit rich. And what do? You think, you know what, sensible thing to do is to lock in some profits. Yeah? And that's what you did at the time, you know. And what's happened since then? The market's gone up and down and up and down. I mean, you're going back to July, when 2019, Pete, and it was £24 a share, 24.5 pounds a share.
Yeah.
Right? We have the meltdown in March of last year, goes to 14, right? And everyone's thinking, you know what, that's the bottom, right? It then pops up and goes to 18.5 in the May of last year, right? Yeah. When all the flux is going, we're going to reopen, the COVID things are dropping, and blah, blah, share price goes up, people think they've got a bargain. And you're getting absolutely walloped, right? It gets to September, just a couple of months later, and it's down at 11.5, right? So you've got to hold through all that noise, all that flux, all that grief. The shops are closing. We're going back into lockdown again. You know, COVID numbers are going up again. And since September, it's gone from 11 to 30, Pete. Now, I mean, you tell me who's been buying that 11 and 12 pounds since December and kept it all the way through? Or who bought it back in 2019 when it was at £10 and kept it all the way through all of that? That's a lot of noise to deal with, mate.
It would have been very difficult, wouldn't it? You are right. I mean, that's a good way of looking at it. I guess the point I was coming to was that, or sort of alluding to, was linking to what you said earlier, that, you know, if we're continually looking at all these stocks, there's always that danger that you're going to end up selling something that's really good that you already hold because something else over here has taken your fancy. And you sort of got to break that habit in a way, only buy that thing over there that takes your fancy if it really is that stunning, you know. But otherwise, let it go. Just tell someone else back, say, hey, there's this interesting stock out there, have a look at it. I don't want to buy it myself because I've got enough slots filled, you know.
It goes back to the importance of psychology, Pete. You know, there's really, really strong opinion on Twitter, across social media, in blogs, in articles. When the stock gets walloped, all those opinions go out the window, and you're seeing the absolute stampede of people selling, and the share price goes from being a darling to being alienated, and the CEO and CFO get in absolute grief because they've come out with a profit warning, or they've not quite met that metric, and the share price is down 20-30% in a heartbeat. And this goes back to people promoting illiquid stocks. The only reason why they're promoting that illiquid stock is because they want to get a better price for it themselves so they can exit. You know what I mean? They're not trying to help you out.
Yeah.
You know, so yeah, you've got to be mindful, Pete. And it goes back to the psychology. If you think you've found a really, really good company, what time frame are you buying it for? Are you buying it for 10%, 15%? Or are you actually buying it to hold it long term? And it goes back, and I keep repeating almost the same person all the time. My favourite person to quote regarding investing long term is Phil Oakley. Buy quality stocks and forget about it. You know, and if it does drop like Greg's did, and you still like it, and you're really, really thinking that long term this company's going to do well, hold a stock, let it go down, buy some more near the bottom. You may not call the bottom, buy some more, reinvest your dividend, and think about holding the stock for 5 years. Think about holding the stock for 10 years. And I guarantee if you're holding it for 10 years, you will be in profit if you've got a quality stock, not a tiny liquid sub 100, 200 million pound stock. That's got a really good idea now, but might get wiped out in the next 3 to 2 years.
This is a quick hello to you, our valued TwinPetes Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe, and you'll always be the first to get the new episodes. Thank you for your continued support.
Oh, totally. Hey, in that, you mentioned the word profit warning. I want to just throw something by you. I've been, thinking about how I do things and, how I can optimize my returns and all the rest of it within the constraints of not trading all that often and, you know, all the other complications of life. And one of the things that really struck me, because we've discussed stop losses a million times, and I don't really get on with it with my long-term holdings. So it's not something I want to do. But one thing that I know a lot of good investors do. I mean, there's Bill, at the Stock Whittler. I think he's at Dosh100 on Twitter.
Yeah.
Really good guy, Bill, and totally honest, and you can trust him. And one of the things that Bill does, I know, is that if one of his stocks has a profit warning, there's no hesitation. It's gone. It's out the door. It's just gone. Yeah. And because the problem is with profit warnings is that one comes out, and quite often, but they always say, don't they, profit warnings come in threes. So quite often you're going to get another one a few weeks later or a few months later, and the same going forward. And the share price gets absolutely annihilated. And I think if I just introduced that thing where I said, right, first profit warning, bang, out the door, yeah? And maybe that's what I need to do. What's your sort of take on that, mate?
I think I'll go back to what I've just said to you, Pete. It really depends on the company. Sometimes it's a huge structural issue. Sometimes it's accountancy. Sometimes it's something that can be rectified within weeks, within months. It really depends on the company. I assessed every single profit warning individually regarding that particular company. And sometimes there's an absolute bargain to be had. And in the blink of an eye, you've got somebody saying, actually, this is the reason why this profit warning took place. Because the RNS sometimes doesn't tell you the full picture, Pete.
Yeah.
And immediately, because expectations were quite high, usually regarding, said company, that profit warning is it's like a death knell to some people. But it creates an opportunity for those people that are rubbing their hands together going, oh, yes, indeed, let me have some of that. And they're slowly accumulating that position in that stock. And, invariably, I would say probably 50% of the over 50 stocks that I've had that have been approached for takeovers in the past 7 years, Pete, I've had a profit warning at some point or other, and the share price has been decimated. And I've watched the stock, gone back out, picked over the bones and gone, actually, the sum of parts here is 50%, 60% higher. So I'm going to buy this stock now for 50%. I'm going to get £1 worth of assets for 50p, for 40p.
Yeah.
And I'll wait and see if someone else backs up my theory or backs up what my thinking is. And sometimes I'm wrong and sometimes I'm right. But what you're seeing now, and you said there's not much news going on at the moment, Pete, is that the vast majority of stocks that are being taken over have had a profit warning, have had difficulty, have gone nowhere for ages. The share price has just traded in a small range for 3 years or 5 years or whatever. And all they've done is actually given out a bit of dividend when they can. But the share price hasn't done anything, Pete. So for profit warnings, look at why the stock has had a profit warning. Look at whose fault it is. Is it a case of they've lost a major contract? You've got companies like, one that I've mentioned to you in the past, Loop. You've got contracts with X, Y, and Z. If your major contract is with one company, most of your revenue is with one company, yeah? Sorry, Ixico is the one I'm talking about. Sorry, Ixico
IXI, yeah.
IXI. Most of their revenue was with this company, and they came around and said, actually, we're going to reduce the amount of revenue we're going to give you and reduce this contract. Blah blah. Wallop. The share got absolutely creamed. I've still got that stock, and I continue to hold it. Yeah, and I added some more. So you've got to assess it each time. Greg's is a prime example. They had different things going on with them. Yeah, I'm sure Clarkson probably had a profit warning or two in its time. We talked about Ashtead in the past, Pete. Yeah, probably the most profitable returned company from the crash of 2008, 7, 8, 9. For anybody that's held that stock all the way through, it was pennies in the pound, Pete. Yeah, so you've got to assess. Bill's way of going about it works for Bill, and Bill's really good at picking stocks, really transparent. He's got an ultimate level of integrity. Yeah, and I trust Bill. Right, so if that's what he wants to do, that works for Bill. It's not the case for everybody to go around and do exactly the same thing. If you're really concerned about the stock, sell it. But forget about it. Don't keep coming back on Twitter going, that's one of my ex-holdings, that's one of my ex-holdings, that's one of my ex-holdings. Yeah? Because that's just burning a hole in your psychology, because you don't trust yourself when the next profit warning comes. Or when a stock gets too rich, you don't want to sell it, just in case you're missing out on it going even higher. Yeah?
No, that's really interesting. I mean, to be honest, you're probably pretty much where I am in terms of how I do it. But I do think I need to be a little bit more aggressive when there are profit warnings. I think sometimes I overlook problems that then go on to become even bigger. So I think I just need to get a bit smarter at that. But, I think there's a principle there that can be useful, really.
The main principle, Pete, is exactly what you've said. Dig deeper, right? If the profit warning comes, I mean, this is why I hate people putting out profit warnings at quarter past 4, 3:15, or after the bell, right? Because you've got no chance of getting a grips of it. If it comes out at 7 o'clock, I know you don't get up that often at that time, Pete, but
oh, come on.
For those of us that get up early,
what, 7 p.m. are you talking? I might be up for 7 p.m. maybe.
For some of us that get up early, you've got that hour window to actually read that RNS and get the grips of it. And if you know the company well enough, you can read the RNS and go, aha, that's what's gone on there.
Yeah.
And regardless of what the market does, it can go down 20%, 30%, 40%. You're not panicking.
Yeah.
Right? You're thinking, right, let me just see where this bottoms, if it bottoms. And you can wait even till the next day and see if it bottoms. And then because you know what's going on with that company, Pete, if you've got some cash left in your account, you go, I'm going to buy some more now and wait this out for another year.
Yeah.
Yeah. And lo and behold, they rectified the mistake. Or some predator comes in and says, you know what, that share that was last year profit warned at £1, we're going to buy that at £1.50. Depending on what your average is, you should be up. Are you with me, Pete?
Absolutely. Do you know what? It brings me to another sort of linked subject that I've been quite amazed because I accidentally saw the starting figure for my ISA portfolio, which is really where I hold the WD-40. Yeah, I saw the starting figure for that back in 2009. So it was like January the 1st, 2009. It was worth a certain amount. And I noticed that since 2009, it had doubled and then doubled again. And I sort of mentioned this on Twitter. And thankfully, Roger Green, thanks, Roger, fantastic. And Mark Bentley, thanks, Mark, came back to me and they said, well, that's a return of 12.2% CAGR, which actually I'm quite pleased with. I mean, even though the last sort of 12-year period has actually been quite a historically easy period for stocks, I think. And I think, I've taken money out. I've taken not a huge amount, but I've taken a chunk of money out. So that's money that isn't in that pot. So actually the return would be higher. And obviously that money, that cash hasn't been reinvested. So I'm quite pleased with that. And one of the things that's really interesting is that when I look at the returns I make, and when I look at the returns people that I know well and whatever, that may do things different. They may sell on a profit warning or they may use stop losses. I look at what they do, and the returns I get aren't hugely dissimilar to what they get. And it's like we discussed on TPI 55, the last podcast. I find the biggest determining factor is whether you're buying small caps and the number of stocks you hold. That seems to have more bearing than anything, than any kind of, clever techniques and whatever you use to try and manage the portfolio better.
Pete, I would caveat that and say I agree with you, but I'd caveat that. I think the best measure of returns is the length of time you've held a quality stock. If you've held it for a long time, that will far outweigh the people that are trading for 5, 10, 15% in, out, in, out, in, out. Their CAGRs are going to be great one year and decimate you the next.
That's a good point. I like that.
Holding a quality stock for 5, 10, 15 years will far outweigh anything that a trader can put together. Yeah, because you're going to hold quality stocks in your portfolio, 5 of them, 6 of them, 10 of them, 15 of them. And over 10 years and 15 years, they're up 300, 400, 500, 600, 1,000% if you've got a really, really good stock in your portfolio. Now, how many times is a trader going to have to scalp 5, 10, 15, 20% to get a stock that's generated them 1,000%, Pete?
They're going to be pretty busy. And they need to be very good.
Absolutely.
No, do you know, that's a really great point. Hey, I've got something else linked to this that came up. I had a lovely day on Friday. I met up with about, well, there was 10 of us, right? Met up in the White Hart as usual. And, you know, various discussions, various topics and that. Hello to everyone again. And one of the things that came up was that a couple of the guys at the actual meet, they told me that they don't really measure their returns of their portfolio. And I'm amazed by that. They don't do a weekly return or a monthly return or a yearly return. I was absolutely astonished. And I think the view they take is, well, you know, I look at my portfolio and every now and again, as long as it's up on where it was last time, I'm pretty happy. And the thing that strikes me about that is that if you don't get at least a yearly, you know, what you had January the 1st at the start of this year and what you had on December the 31st and just work out the percentage difference. If you don't do that, you've no idea if you could be performing better, if you're doing things in a suboptimal way, if you're, you know what I mean? But what's your take on that?
I think it's a very individual thing, Pete, and it's important for it to be so. I'm not a big fan of talking every day about year-to-date performances, weekly performances, monthly performances.
But you monitor year-to-date, don't you?
I don't talk about year-to-date for my portfolio. I talk about percentage returns for my individual stocks and what they've done year-to-date. Overall, I talk about my portfolio as said whether it's. I only talk about it when it's at record highs, which happens occasionally. That's only what I do. But I do off Twitter and off social media. I measure my CAGR. Never talk about it on social media. I measure what I've done because I'm competing against myself, Pete. I'm not competing against anybody else. All I'm trying to do is get better at this game, which no one becomes a master of.
Well, that's exactly my point. I'm not talking about whether you say anything on Twitter, but there are these guys who don't actually work out their CAGR at any point. And I just to me, I mean, they might be doing 7% a year and thinking they're brilliant, when in reality, they're probably underperforming by, I don't know, another 7% a year. You know, that I just find astonishing. So anyway.
I think some of it, Pete, is that some people may not know how to measure their CAGR because they take stuff in and out and they don't know what to add and what to subtract. What I'll do with this particular one is I'll add to the Conquest 3 website, and I'll give you the link as well, Pete, so you can actually put it onto your Wheeler Dealer website as well, a CAGR calculator that people can actually use to actually measure their performance, so they can use it if they want to use it, if that's any use to anybody.
Oh, that's fantastic. I mean, on Excel, you can use a thing called the XIRR function, and that enables you to put money in, take money out, and track it. You have to record it on the spreadsheet. And that will work out your CAGR as well.
Yeah, that's one way of doing it as well. Yeah.
Yeah. No, it's interesting. I find the whole CAGR thing is, like, it is really useful to know how you're doing. And, you know, when I hear I'm doing 12.2%, and in reality, I'm probably doing a little bit better. And I think that compared to how my capabilities as an investor in 2009, I think I'm streets ahead of that here in 2021, partly because meeting people like you, Pete, you know, and whatever, you know, the interactions from Twitter and doing Wheelie Dealer have taught me so much. You know, it's pushed me to another sort of level of the game. So I'm sort of quite happy that I'm doing probably around 13% CAGR when for a lot of the time I didn't have a clue what I was doing. So yeah, it sort of makes me feel quite pleased going forward that I'm in a good position to do okay, you know.
It's really important, Pete, that we get to a place where we're comfortable with the amount of knowledge that we've attained, and that we're comfortable with wanting to learn more. And I think the important thing is, you and I aren't scared of being in a room where we're the dumbest people, or people on Twitter calling us stupid.
Well, get used to it,
because we're open to learning. We're open to being embarrassed because we don't know stuff. We're open to asking questions that we're not sure about, and that to me is about being very open-minded, and open to other people's knowledge, and being able to ask somebody something that is more knowledgeable about a topic or a subject matter, and just sitting there and just being, go on, feed me. Not that you want to take away what they're giving you in a sense of I'm going to copy what they're doing in the sense of they told me about their stock, but because you want to learn about their process and methodology, because you can repeat and learn methodologies. You can't repeat copying people. This is what I keep saying to people. It's that thing where I don't know how to fish, Pete, right? So if you took me to a river and said, right, let me show you, and spent a week or 2 weeks or whatever it is showing me how to fish, eventually I would know how to fish, and I could feed my family if that's what the source of food that I had to do. But if I was just trying to copy somebody from watching them, maybe I wouldn't be able to do that. Maybe I would never learn properly. And that's the beauty of Twitter, that people are actually deciding now to read more and more and more books, to research more and more and more. You don't have to have a profit warning in BOTB to think, another lesson I've learned. I've got to decide not to follow that guy anymore, or that woman anymore. I've got to read this stuff. I've got to read that. There's too many people, and it really irritated me, Pete, how many people got hurt by the BOTB stuff, of no fault of their own. Yeah?
Oh, there's so much of it. Mate, I'm aware that time's cracking on. You wanted to talk about your event in Leicester.
I did. First of all, I wanted to just thank everybody with regards to the donations they've made so far regarding the TwinPetes Challenge. It's been absolutely phenomenal. So far, we're sitting at a figure of £7,660, folks. So I'm absolutely chuffed to bits that you guys, ladies and gents, have helped us get to that particular figure. What we've done so far has been pushed a bit higher, because one of the events that I'm putting together is going to be involving two companies. One's called Orphan, and the other one's called Poolbeg. And the CEO has kindly donated £2,000 to us on the TwinPetes Challenge for the event I'm putting together for that. We've also got a sponsor from London South East. Dave Mutton has really been really helpful and supportive, and so has the rest of the team regarding the event, and they sponsored us as well. And also obviously our own sponsor at SharePad have also sponsoring the event. So those monies are going to be added to the coffers going forward. The event, as I spoke to you guys and ladies before, is going to be on the 17th of September in Wigston, Leicester. And what I've done today, I've had a conversation with the nearest hotel, which is about 2 miles away from the event. And I'm going to be getting a discount code for people to be able to stay who are travelling from outside of Leicestershire and want to stay overnight, to get a discount code that will probably give them about 15% off at the Holiday Inn, which is about 2 miles away from the event. So once I've got that discount code, I'll add that to the website page and elsewhere, so that you guys and ladies that are travelling to the event can come to the event. I wanted to say also that we've got a phenomenal chap. It's at Tomo03, I think is his Twitter handle. It's called Steve Thompson. Is Steve Thompson MBE, and he is a World Cup rugby winner, 2003. And he's going to be our guest, our main guest speaker. Going to be talking all things rugby, all things business. He's involved in a brewery, which helps. So we might be getting a few free beers on the night. That's just a hint, Steve, if you're listening.
Sounds good, mate.
So Steve's going to be our guest speaker. We're going to have 2 listed companies. We're going to have 2 other speakers as well, minimum. I'm going to be putting on some free food and booze as well for our listeners and also our donors who've already donated. All you've got to do is just send me a little tweet to confirm that you've already made a donation. I'll put your name on the list. get your email, and then send you all the different information. It's an invitation-only one for our listeners. Other people have got other things going on. It's going to be open to between 80 to 120 people. Once we get the numbers, we're done, and then it'll be a closed shop. You can't just rock up, turn up, and be allowed in. You won't be allowed in for safety reasons, security reasons. But yeah, we're on our way. It's going well. I've been doing a shed load of work on this, and I'm hoping to make it a phenomenal night. We're going to have a raffle as well, Pete. So I've already got some England football, England versus Hungary. I think it's in October. Got some tickets for that. Got probably some beer kegs. And some other bits and pieces and prizes that we're going to have for raffles. So we're going to try and raise some more money on the night. I'm going to quickly run through the individuals that have made some other additional donations to us, Pete, over the past 2 weeks. Very quickly. We've got Mark Travis, who's at Silver Bear Mark. Mark writes, good cause and great podcast. All the best at Silver Bear Mark. £20 and gift aid. Rob G, I don't know what Rob G's would like to say. He just left it blank there, but I did do a double check, and Rob G donated £200. So thank you, Rob G.
Oh, nice one.
The Secret Accountant, who we all know is on Twitter. Well done promoting the charity. Excellent podcast. Thanks for all your continued hard work and time you put into it. Here's just a small token of appreciation. It feels good to give something back. €50. I think he did that whilst he was in holiday. He sent us a tweet, Pete. Remember, from Pharma?
Oh, yeah, I remember.
Yeah, that was we weren't jealous, Secret Accountant. We weren't jealous at all that you were in Pharma. Thank you for that £50. Chris Badger, hi both. Just want to say thank you for the extremely informative podcast. Usually insightful and informative each and every time. Keep up the good work. £30 plus £7.50 gift aid. Your mate and our mate Phil Sloan, I think that might be his second or third deposit he's made there.
Well, he's made a lot of money on his big box right.
I see. So thank you very much, Phil. Brilliant podcast and a wonderful cause. Keep up the great work, fellas. £20 from Phil. William Kemp, good cause and great podcast. All the best. £10 and £2.50 gift aid. Excellent. Caroline, £20 plus £5 gift aid.
Oh, we know Caroline. I think I know Caroline, yeah.
Okay, brilliant. Thank you, Caroline. Liam Sharp, keep up the good work, lads. £10 and £2.50 gift aid. Darren at DM_invest43, thank you. Love the podcast. Good luck raising 15k. £30 plus £7.50 gift aid. Will Woodward. Never missed a podcast. £20 and £5 gift aid. Thank you, Will. Mark Dean, I don't know what his handle is. Mark generously just donated £200 plus £50 gift aid. Wow, Mark, lovely. Thank you ever so much for that. That's brilliant. Terry, I think that won't be your mate again. That's Nicholas Vaughan 1. I think that's Terry again.
Yeah, that's Terry Vaughan. That's one.
Thank you to the two Peters for sharing their 50 years of investing knowledge and experience. Keep learning, be prepared for a bumpy winter on markets and maybe a good opportunity. Take care and God bless. I'm going to be matching all Terry's donations, so I'm glad to see him continue to do that. And obviously the £2,000 we got in from the association, from the Poolbeg and Orphan, and then your friend of mine, Ian Sellers, dropped in £30 as well. So
that's fantastic.
Thank you all. You're all absolutely wonderful individuals. And if any of you want to attend the event in Leicester, just send me a tweet or a DM and I'll sort out and make the arrangements for you and send you an email regarding all the details. Anybody else that hasn't donated yet, please join the TwinPetes charity family. You can make a donation on the TwinPetes Challenge Just Giving page, which is justgiving/fundraising/TwinPetes Challenge. Thank you. And please consider, all of you, coming to Leicester. It's a beautiful place and you're going to have a wonderful evening on the 17th of September. Take care. God bless. Love you all.
That's fantastic, mate. We're not going yet. I thought you were about to shoot off then.
No, I'm not shooting off. I just want to say God bless for them guys and ladies that made a donation.
Oh, brilliant. Anyway, just say thank you to everyone who's donated to charity, and well, thank you to all our listeners and stuff anyway. And you don't have to, to make a contribution, but if you can, that would be great. Thank you. I was just going to say, so Pete, how many slots have you got left for your Leicester event?
At the moment, Pete, we're over there at 60 slots of the 120 that
they're going fast.
Available.
They're going fast. You mentioned two companies. Well, one of them is Open Orphan, ORPH is the code, and the other one you mentioned was Poolbeg, which is
Poolbeg.
Poolbeg, which is POLB. So just so people know, mate. I just want to throw in fast. This is the last one where we'll be recording. No, it's not the last one.
We've got one more before the event. We've got one more.
Everyone was going to like panic because it's like the last one we're ever doing. No, it's not the last one we're ever doing. Sorry, what I was going to say, this is the last TwinPetes we're recording before we do the Wheelie Bash, which is on the 4th of September. All the spaces are taken now. I mean, it's had a fantastic response. It's going to be the biggest Wheelie Bash ever. It's going to be awesome. I just want to say something I've decided to do, and I've got permission from Phil, the landlord at the White Hart, to do this. Because I'm only allowed 60 spaces, and to be honest, 60 is probably about the right number. If we had more, it would just get, too big for its own good sort of thing. What I'm going to do next year, we're going to have 2 Wheelie Bashes. So we're going to have one probably around May, June, and I'll confirm the time on that probably early next year. I'll get a firm date. And then we'll do another one, which will be later in the September. And basically, be start of September like we always do. And basically, I'll say to people, look, initially, you can decide whether you're going to come to Wheelie Bash 1 or Wheelie Bash 2, sign up for them sort of thing. And then once we get nearer the date on Wheelie Bash 1, if we haven't filled all the slots, I'll say to people who are coming to Wheelie Bash 2 as well, say to them, look, if you're quick, you can have some of the spaces for Wheelie Bash 1. So anyway, that's just something to let people know it's happening.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a TwinPetes Investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special TwinPetes offer is available to new subscribers only, and you can subscribe using the promo code TwinPetes. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the TwinPetes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Cool. I wanted to say, Pete, as well, the bizarre thing is, with regards to Poolbeg Pharma, is that it got tipped in the paper at the weekend as well. So that rocketed up something like 25% on Monday. And then Open Orphan has got a contract for I think it's his 8 million quid. So that then popped, this week as well. So those two shares are absolutely on a tear at the moment. So they've got a asthma human challenge study contract win of 8.1 million for Open Orphan. So things are getting exciting for both those stocks at the minute. So it's going to be very, very exciting times, Pete. Like, Pete, throw us some stocks, mate. I've got one for you as well. So you go. Okay.
Well, to be honest, this is a bit of a weird one because I want to sort of just take your pulse on one, really. And Deliveroo ROO and Just Eat JET. I was reading about those today and sort of thinking about it all. And one of them, I think, I might get this wrong way around. I think Deliveroo has got a market cap of £7 billion, and I think Just Eat has got a market cap of 14 billion, and both of them are losing money. And they're one of these things where it's all about a platform, and they're pursuing revenue growth over whatever. I just wondered what your sort of sense of it was, and as to whether, do you think at some point in time these will be very good, very successful companies, or are they facing so many headwinds and struggling so much to be able to actually turn profit that they're not going to get there? Well, what's your sort of sense on it?
It's a difficult one, Pete, isn't it? As everyone knows, I like my tech related stocks, and this essentially is a tech, or they're both tech stocks. However, you've still got a big human element to it, in a sense of the individuals on the bikes or in the cars or whichever way they're delivering the product. Yeah. The problem both companies have got is that the individuals need to be paid a decent wage, salary, whatever it is, per hour, per week. Yeah. So that's what's getting
not really been happening, has it?
And yeah, so that's the big issue for both of them. So it's one of those things whereby I like the concept of it. They've both done extremely well during the lockdown. Obviously now there's talk of reopening and people getting access and be able to travel more and go and get their own stuff more and all the rest of it. So I think over the long term, Pete, I think there's going to be a consolidation regarding this space. There's quite a few of them around the world globally, and I suspect at some point Just Eat will either be a consolidator or a predator will come for them, and equally with Deliveroo. I don't see them all being in the same space. And then you've got Ocado and other people doing a similar sort of deliveries, and it's just an expensive thing to do. So I suspect there's going to be consolidation. I don't mind tech stocks or other stocks being loss making, because a lot of the analysts that are looking at stuff are looking at what companies have done historically. They don't like loss making companies. So if the company's not really profitable or been profitable for 2 or 3 years, they're not interested. But Pete, you've only got to look back X amount of years. Nobody wanted to buy Apple shares when they were doing poorly. Nobody wanted to buy Amazon shares when they were loss making. Now everybody's chiming on about Apple shares. Nobody wanted Tesla when it was supposedly loss making. And look what happened there. SMT couldn't buy enough of it, and it made a shed load of money buying it when no one else wanted it. Yeah, so being loss making shouldn't write off a company just because it's loss making.
No, exactly. I mean, it's about when you can see a route through to profit.
Absolutely. Can you see a route? Absolutely.
When you can do a discounted cash flow DCF type analysis on it and think, well, okay, we're not actually going to get any money out of this thing for 3-4 years, but once the money starts coming in, it will be mega. And I guess the problem with things like Just Eat and that, you've talked about the problem with the delivery driver aspects and the regulation around that. Obviously, the way forward, presumably, is going to be when they all go to drones and things, and you get your pizzas delivered by a drone or something, which will remove all those labour costs.
What, just drone? Just drone, it'll be called then? Deliver drone.
It sounds like a TwinPetes podcast, just drone. No. Anyway, So I and then you've got the likes of Amazon are on about doing deliveries, aren't you? And you are doing it, and you think, well, the competition is so fierce, and it's like they're struggling to make money now. You've got competition coming in. I mean, the other thing we haven't talked about is you've got all the green issues around, our little 2-stroke mopeds pumping out rubbish. Is that really good for the environment? Or 4-stroke mopeds, whatever. They all
replace those eventually with electric mopeds, Pete. That's a very good point, mate. They're expensive doing that eventually.
Yeah, so you've got all that, and then you've got things like, I mean, there's big inflation. Well, it was on Jeremy Vine, Vanessa Feltz earlier today on Radio 2, where they were talking about the shortage of lorry drivers again, and how wages for lorry drivers are already starting to rise, because obviously they need to attract people to the industry. Well, the thing is, if people can earn more money being a lorry driver, they'll be thinking, hang on, I'm earning tuppence halfpenny driving for Deliveroo. If I go and take my HGV license, I can earn a hell of a lot more money and probably have a lot nicer life. So, I think there's so many inflation pressures within the within the country, and I imagine that's more than just in the UK. That you can sort of see that they've just got so many pressures on them. I just struggle to see how they're really going to get anywhere unless they get absolutely massive.
Yeah, like I say, I think there's going to be consolidations in place, Pete. On that note, you mentioned all the different difficulties going on. One of the things I had a little chuckle about was McDonald's, or as my young people that I work with call them, Mackie D's, running out of milkshakes.
Oh, yeah.
And not having enough bottles of water because of logistics and all the rest of it. And on top of that, Pete, you've got Amazon saying to people, we'll give you a welcome package, £1,000 welcome package just to take a job with us because they can't get enough workers. Yeah, there's a friend of mine who runs a large recruitment agency, got loads of jobs on offer, not enough people to actually apply for them.
Well, I heard this. I met with a really good friend at the. Actually, that's a good link onto something else I'll talk about. I met with a good friend on Sunday, and she works in recruitment in technology, IT. And she said they just can't get anybody. She said it is an absolute nightmare. Salaries are going up. And not only can you not recruit people, the problem you've got is you've got higher attrition of your own workforce because obviously you had COVID and lockdown and stuff. So a lot of people were reluctant to move. They were just staying where they were. Yeah. Now, because things are opening up, they're all starting to think, oh, actually, I'll start looking for a job. And of course, headhunters are ringing them every day, offering them 20% more salary and loads of share options and God knows what else. So it's like tech companies are shedding staff like it's going out of fashion, and they're really struggling to recruit them, and finding them with the right skills is incredibly difficult. So there's a huge problem with that. And again, that is global. That is not just in the UK. Which brings me on to a company called Activision Blizzard. You know them?
I do, Pete. Yeah.
Yeah. So that's a US stock. So dollar. ATVI. My friend used to work for them.
Cool.
So she used to work for King Digital, which does Candy Crush. Yeah, the gaming.
Oh yes, my wife was.
Because Activision Blizzard are a gaming company. Yeah.
Yeah.
And basically, she highlighted to me that the shares have dropped a bit and whatever. And I had a look on the charts, and shares have really come off a lot. And I was looking at the forward PE on it, and it really wasn't that ridiculous. It was it wasn't ridiculous. In fact, I think it's looking almost positively cheap. It's on a forward PE of something like 20, falling to 18. It was something like that I saw on SharePad. And it's got something like 7 billion of cash. I mean, the market cap is enormous, but it's got a big chunk of cash. There's no debt. And you think, well, actually, for a gaming company of that scale, those are attractive numbers. So I was just saying, that's one to look at. I haven't done any proper research. I'm just flagging it as something to look at.
Cool. Yeah, I think it's one of them, Pete, where they have peaks and troughs and people move from one game to the next game. So sometimes they have a bit of a dip regarding that. Yeah. Yeah,
but the thing is, they're so big. They're so big that they've got hundreds of thousands of games. It's not just one game company anymore. Do you know what I mean? So
definitely one to keep an eye on. The one I wanted to share with people today is, unfortunately, sorry for people, it's another US stock because I was researching a medtech stock that I purchased that I disclosed and put on Twitter last week. But this isn't the one that I've purchased. I found this stock because I was looking at the stock and its peers and all the rest of it. And it's again a US stock, and it's called Medtronic, and the ticker symbol is $MDT. And this stock is £178 billion market cap, right at the top of the quality sort of metric regarding stocks. And it's one of the largest medical devices companies in the world, with products that treat 70 health conditions, including cardiac devices, cranial, spine robotics, insulin pumps, surgical tools, and patient monitoring systems. And yesterday it released strong results for the 3 months to July the 30th, the first quarter of its financial year. Revenues grew 19% on an organic basis to $8 billion for a quarter, Pete. Yeah.
Yeah.
And that was just ahead of market expectations. And growth was achieved despite impacts of some certain pressures and recoveries from the COVID-19 pandemic. So US revenues increased by 22% to $4 billion, whilst non-US developed markets revenue grew 11% to $2.6 billion, and emerging markets grew 25% to $1.3 billion. So you can see that globally, this company is still rocking and rolling. The business is split in four portfolios of cardiovascular, medical surgery, neuroscience, and diabetes. So that's a very, very high quality stock to people to have a look at and investigate. That's one I looked at and I thought, I've got my eye on it. I chose a different company in a similar sort of space.
Mate, I beamed up SharePad. Yeah.
Yeah.
I was just going to say quickly, if anyone is interested in having SharePad, there's an advert that we run, if we can call it an advert we run during the podcast, whatever, where if you want to sign up for it, you can get 1 month's free data, and we get a drink out of that as well, which is very nice. Thank you. Anyway, yeah, I just want to say on MDT US,
yeah,
SharePad is showing a forecast PE of 23.3 and a 2-year forecast PE of 21. Now that strikes me as not overly mentally expensive for a stock that's in a strong uptrend, that's in a sector, i.e. health, and particularly medical devices, that we know is a sector that's doing really well. It doesn't seem at all bad. So yeah, I think as a tuck away, it could probably those are attractive numbers.
Yeah, not too bad, Pete. The last one I wanted to share with people, it's not a stock that I hold. I don't think I've mentioned this one before, and it sticks with the stocks we've mentioned before, Pete. The DIY sort of materials, people are using these sort of stuff. This is like a theme we've been running since last year. Everyone's doing up their houses, everyone's having extensions built and so on and so forth. And the company is called Grafton, Grafton, and the ticker symbol is GFTU, and it's a buildings material distributor and DIY retailer. Yeah, and that came out and posted record first half operating profits thanks to the strength of the home improvements market. Again, home improvements is the theme here with this one. The company operates the Selco distribution business and the Leyland SDM DIY chains in the UK and across Ireland. Some of the people that we know in Ireland would know them as Chadwicks and Woodies in Ireland. And they reported a 46% increase in revenues to 1.03 billion for the 6 months, and a 204% increase, Pete, in adjusted operating earnings before property gains to a record £142.4 billion. So that's another one to keep an eye on, folks, I reckon.
Yeah, I was just beaming up as we speak. I was just trying to look at Grafton on SharePad. It's showing a forecast PE of 19, 2 years out, 18.9. Doesn't seem crazy, this part of the cycle. Yeah, could be certainly worth looking into, isn't it?
I don't think people are going to stop doing up their houses, Pete. I don't think they're going to stop doing up their houses, and I don't think builders are going to stop building anytime soon. So that's their half-year results out today. We've got a 52-week low of £6.27 and a 52-week high of £13.66, and today it finished at £13.59, so it's right up there. 1 year return of 91%, year-to-date return of 47%. It's doing extremely well. And again, even better, it's not a stock that's being ramped. It's not a stock that's being talked about. And these stocks that are not being talked about are outperforming the ones that are being talked about and ramped. You know what I mean?
Oh, totally.
Happy days for shareholders that are holding that.
Oh yeah, mate. It's a lovely uptrend on the chart, so that's sweet. Mate, what I want to throw in before we finish, we're running tight on time.
Yeah, running tight on time, mate. This the last one.
I just want to mention Sanderson, which I think is one we've mentioned before, but it's had results very recently, like a week ago or something, and it just struck me this is really looking quite a good value. Sanderson used to be Walker Green Bank, so they do like fancy wallpaper and stuff, And anyway, they're on a forward PE of 16.7. Dropping to 14.9, and you've got a dividend of 1.7 rising to 1.9%. thing is, it's got a lot of cash as well. So I'm pretty sure in the last update, which was like a week ago, anyone can read it. I think they said they were ahead of expectations, and they got a load of cash as well. You strip that cash out, those PEs come down probably 2. So it's probably forward PE of 14.7 and a 2-year forward PE of 12.9. That is attractive numbers for a stock that's beating expectations. So I think that's an interesting one.
It's one I raised back in June, Pete. One of the podcasts in June, and around that time it was about 165, 167 or something like that a share.
What's it now?
It's sitting at 199, 198 and a half. £2 at the minute. So it's moved on a little bit. It's come a long way from 54 pence, 52-week low. Good. It's got a high of £2.10. It's up 254% over 1 year. And year to date, it's up 123. So it's not one to chase, but it's definitely one to keep an eye on. And just with all the others, mate, it's in a sweet spot because people are doing up their houses.
Absolutely.
So it could go higher.
Not just that. With WDG, I think it's a bit family run, I think. And I think it's historically...
SDG, Pete.
No, but it used to be WGB. Yeah, right, in the old days, it used to be Walker Greenbacks. I actually held it for a while, but like me, I'm completely stupid and I just sold it. So I think they've got a much more on the ball management now. They just strike me as a lot more different, and the thing they're doing that was announced the other day is they're starting a TV advertising campaign. They've never done that before. So if they get their wallpaper brands and that more out there and in people's faces, I mean I don't know whether there's any sense to this, but they're running a story that they're making out on their marketing, that it's all about if you've got nice wallpaper, then you'll feel better about your life and it's good for your psychology when you're stuck at home. I'm not sure how.
I used to work in the healthcare services, mate, and did a lot on psychology, and you'd be amazed how aesthetically a different room affects people's moods. So they've done their research, they know exactly what they're talking about, and it does work.
So do you reckon if I slam some sort of old, flash expensive wallpaper on my lounge wall, I'll feel a lot happier?
That's not what I'm saying.
Right.
I'm saying different colours and different tones, and different moods. It goes back to what people were saying before, regarding rooms, Pete. Getting rooms, flowing and so on and so forth.
Feng shui, mate. Feng shui.
That's the word I was trying to find.
You need a bit of feng shui.
It's now 20 to 8. My brain's pickled. Feng shui is exactly the word I was looking for. But colours helps, Pete. It's a bit like when we're in the countryside and we see lots of different, colours. It just helps, mate. It helps the moods.
Yeah.
All right, folks. Listen, we've hit 76 minutes again. We've run out of time. I want to thank everybody wherever you are in the world listening to this podcast. Thank you for continuing to support this podcast. Pete and I are absolutely chuffed to bits that you take the time, and sometimes a lot of time, to listen to it in one part or in 2 parts. So thank you ever so much for continuing to support us. Thank you ever so much for your feedback, good, bad and indifferent, because that helps us to get this podcast better. Thank you ever so much for supporting us regarding the TwinPetes Challenge. I'm hoping to see some of you on the 17th of September in Leicester. And I just want to say, we're all in this together. We're all in this trying to get better. And if we can show each other some kindness, we will all be in a better place over the long term. And as Pete says, you know what? The investing gods are watching us. And the more good that we can do, whether it be regarding investing or in our communities, someone's looking out for us. So take care. God bless. Look after each other. And we'll see you in 2 weeks' time.
Cheers. Bye.
This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.